So in today's video, guys, we are going to discuss a basic principle of IAS 36. So when we talk about IAS 36, guys, we are talking about impairment loss. This is one of accounting standard that most of the institutions that they are doing accounting standard, obviously they also pick up this topic as one of the topic that need to be covered. So please make sure that you stay tuned so that you will know the basic. Before we start with trick questions, make sure that you understand this basics so that you will know that when we talk about IAS 36, we need to apply a certain principle. Okay, so I did some notes which I'm going to show you on the other side. So when we talk about impairment of assets, guys, what is needed under each and every company or institution, IAS 36 require entity to assess whether an asset's carry amount exceed its recoverable amount and recognize any impairment loss. Okay, we are going to discuss about recoverable amount as well, impairment testing, and recognition. All right, in simple terms, guys, when we talk about impairment loss, we are talking about unexpected loss occurred. When we talk about impairment loss, in other words, is the loss that we didn't expect at all. It's just happened as a surprise. That's a simple term that I can use to define a word impairment loss. Some of you can say that, but impairment loss is not different with depreciation. It's different, guys. The difference is that when we talk about a depreciation, when we buy an asset, we know that that asset is going to depreciate. That vehicle, that computer, that equipment, that building that we purchase, we know that we are going to calculate depreciation every month, but we never ever expect it to do what? To be impaired. Okay, but because it's item that can happen, or is the thing that can happen, we have to have a standard that regulate this loss. If it happen, it's known as International Accounting Standard 36. Okay, before we proceed, maybe let's do examples so that you can understand what is impairment loss. Examples of impairment loss. Number one is car accident, guys. When we talk about accident, guys, obviously no one planned for it. It's a things that just happen on a road. Like you can go, maybe you were going somewhere, going shopping, going at work, and maybe when you go to the robot, then you find that something happened, which we call it accident. So it's something that you have never planned. You were going to work, but because of things happen, you got an accident. So it's things that you have never expected that it will happen. Okay, number two, natural disaster. Natural disaster. When we talk about nature, guys, it's like a weather. You never know whether next month is going to be hot or it's going to be heavy rain, it's going to be floods, something like that. We never know. It's something that we didn't expect. Okay? Natural disaster, it can be floods, heavy rain. Heavy rain can cause impairment, guys. Why? Because you can find that we have a building and there was a heavy rain and some floods and our building fall, which means that that's not a depreciation. It's impairment loss. We didn't expect it. Okay. Another one, we have a change of fashion. Change of fashion, guys, can cause impairment. If I'm wearing, for example, MX, okay, I'm just doing an example of MX. Before MX, there was some Nike techies that they were selling, but after they introduced MX, it's a new fashion, which means that the old Nike, the price is going down now because of what? Of new fashion that has been introduced. Because, okay, remember, if they were selling the old one by 1,200, now they are coming with MX and the same MX is 1.5. The only difference is very slim, only 300, which means that people can go for this one than the old one, which means that this one, in order for them to sell this one, they have to break down this price maybe into 900 so that people can go in and buy. Very simple like that. Okay, now another one, a new introduction, or let me just say new technology. A new technology can cause impairment, guys. For example, before we have laptops, we used to use computers. Now, because we have a laptop, they reduce the price of what? Of computers. Now, mostly, they no longer produce those old computers. They are producing laptops and all those new kind of computers, because those old ones, they no longer have a price. For the other example is that, you know, there was a Samsung, the E250, the one that we used to slide. Now, because we have a new cell phone of touch screen. Remember that E250, I think it was costing more than 900 when they introduced it. But now we have a lot of touch cell phone that we can buy by that 900, which means that the slide one is out of what? Out of technology, because of new technology introduced. It's called impairment. They didn't expect that a new method, iPhone is going to introduce a new method of touch and what. Okay, then the other one, guys, change of politics. Obviously, change of politics can also influence what? Impairment. Some business might fall because of new regulations. Okay, and the other one that I want to talk about is selling of an asset. Okay, this one can also apply under IFRS 5, non-current assets held for sale. Okay, then how does this one cause impairment? Selling of assets, guys. No one can sell an asset if that asset is still very useful. There is no way. Once you want to sell something, there is an indication, especially a car. If someone want to sell you a second-hand car, just know that probably this car have a problem. You need to calculate, or you need to test impairment. Okay, now because we know what is impairment, we also have to know what is recoverable amount. Recoverable amount. A recoverable amount, guys, when we talk about recoverable amount, it's amount that we can recover after impairment. Okay, let's say, for example, we used to have a car which worth 1.5 million. That car got an accident. Obviously, we can't sell it by 1.5. We have to sell it by lower price. Maybe we can decide that we can sell it as a scrapyard by 100,000. We call it recoverable. It's the amount that we are going to recover. Okay, how do we test impairment? When there is an indication of impairment, we need to test whether there is an impairment or not. Because some indication, guys, you can't see it by your side, but by your eyes, I mean. Like a new technology and selling of assets. You can't see it like an accident. Accident, obviously, you can see that this thing is broken. But some things you need to test first. Okay, how do you test? We identify a recoverable amount through a fair value of that item. Then after that, we compare it with carrying amount. Okay, how do we do so? Guys, when we talk about a carrying amount, we are talking about a book value. Book value is cost minus depreciation, accumulated depreciation. So if our carrying amount, we found that in our books, because it was costing 1.5 million, maybe, for example, when we less accumulated depreciation, we found that the carrying amount is still 900, but because it found an accident, or it got an accident, recoverable amount is 100,000, which means that this amount is so higher, guys, than recoverable. We are going to recover only this, which means that what to do now? Remember, an asset in terms of IAS 16, it must be measured at the lower cost. Remember, guys, when we talk about IAS 16, which govern an asset, it's measured at the lower cost. Simple means that, guys, we can't record our carrying amount as 900 because we have to follow this principle. In other words, we have to adjust so that we can record as a what? Recoverable amount. Okay, how do we adjust that? Which means that the difference between these two, recoverable amount and carrying amount, we call it impairment loss. Impairment loss, which means that in this case, our impairment loss will be 800,000. Very simple. Now, if you are required to prepare a journal entry, which means that what we were going to do, you were going to say, I'm going to debit impairment loss because it's an expense. Guys, under income statement, P&L, amount you debit 800,000 and you credit accumulated impairment. Accumulated impairment loss and credit 800,000. This is statement of financial position because you are going to deduct it under what? A carrying value of what? Of a balance sheet, under a balance sheet, under PPE item. So this is how you should recognize impairment loss, guys. So under part 2 of this video, we are going to cover what we call it impairment reversal. We are also going to cover a recognition and measurement, case generated units, reversal of impairment, and disclosure of IAS 36. I hope by this video now you learn how to recognize impairment loss and how do you see that this is an indication of impairment loss. Thank you so much for watching, guys. Please don't forget to like, subscribe, and share, guys, with your classmates that are studying this accounting standard. I will appreciate it if you subscribe, guys. Our channel is growing. This year we want to reach at least 10,000 subscribers. I'm gonna see you on the next one.